one of the core areas of our research is profitable growing small cap stocks. We just completed a webinar on how and where to find 10x stocks, or essentially great long-term growth stocks. The data tells you that profitable microcap stocks are fertile ground for identifying potential 10x stocks. In the webinar, we included 10 traits we look for in a potential 10x stock. One question we get seemingly more and more often these days surrounds the idea or ideal of a moat, which is one thing we look for but cannot always define with confidence, particularly in the small cap arena. So today I thought I would give you a brief definition of what moats are in terms of investing and if they apply to identifying great long-term small cap stocks. Now, this segment came from our overall 10x webinar. The segment that it came from was how to identify profit or the profile of a great 10x stock. It was one of the 10 traits that we used. So I'm going to first define what is a moat or a key advantage. In finance, we kind of love using both sports and military related terms to describe what we think are like economic terms. So the analogy relates to moats that would surround medieval castles and act as barriers of protection. Put differently, an economic moat describes an advantage that is difficult to copy or emulate, giving a business the ability to maintain a competitive edge over its competitors. Now, the term was made popular by Warren Buffett, who described how seeking such a business is fundamental tenet of his investment strategy. Let's look at that direct quote from Buffett. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and above all, the durability of that advantage. The product or services that have wide, sustainable moats around them are the ones that deliver rewards to investors, from Warren Buffett. Of course, not everyone believes economic moats are the bee's knees for a company or in the investing world. Enter Elon Musk, for example. He so eloquently stated, and I quote, "I think moats are lame. If your only defense against invading armies is a moat, you will not last long. What matters is the pace of innovation. That is the fundamental determinant of competitiveness." Now, here I would say both have points, but I think also that they're both not mutually exclusive. I would not think for 1 minute that Buffett believes that once a company achieves some sort of economic moat, hard or soft, they can just rest on that said moat and forever milk the profits. He believes in innovation. In investing, nothing is a straight line. Arguments are not black and white, and goalposts are always changing. I believe Buffett understands that to sustain a moat, innovation is critical. Therefore, you can want to find businesses to invest in with moats and also require them to innovate to sustain that moat. But for Musk, a nuanced argument, while likely more correct, does not make for a good quip or tweet, such as moats are lame. So let's look at the 5 basic economic moats. The first would be the network effect. The network effect is defined, it's really present and found when the value of a product or service grows as its user base expands. Each additional customer increases the product or service's value exponentially. An example of this, the more customers who use, say, the Visa V card, credit card, the more attractive that the payment network becomes for merchants, which in turn makes it more attractive for consumers, and so on and so on. It builds on itself. So let's look at intangible assets. Though not always easy to quantify, intangible assets may include brand recognition, patents, and regulatory licenses. They may prevent competitors from duplicating products or allow a company to charge a premium in terms of pricing. Walt Disney is a good example of a company that's built a moat based on the intangible asset of brand. In fact, strong brands support robust and sustainable economic profits at both of Walt Disney's or all of Walt Disney's real key businesses. Starbucks is another good example of that. In terms of patents, many drug companies with long-term protected patents offer exclusivity and are a good example of this type of moat over time. Let's look now at cost advantage. That would be point number 3 here. Companies are able to produce products or service at lower cost than competitors, are often able to sell at the same price as the competition and gather excess profit, have the option to undercut competition. Now, If you can make it for less, you can sell it for less. This can apply to manufacturing or other industries. Buffett, when thinking of low cost production moats, uses Geico, Berkshire Hathaway acquisition, a long-time company in his portfolio. As an example, Geico is considered a low-cost insurance provider. It has been essential for the company's competitive advantage. Number 4 in our 5 basic economic moats is switching costs. Switching costs give a company pricing power by locking customers into a unique ecosystem. Beyond the expense of moving, they can also be measured by the effort, time, and psychological toll of switching to a competitor. Consider Intuit, which offers its customers various bookkeeping software solutions. Because learning to use Intuit's applications take significant time, effort, and training costs, few users are willing to switch away from the company. Similarly, if not better examples are Adobe and Autodesk. Autodesk's AutoCAD computer-aided software application for 2D and 3D design and drafting. It's very hard to change this over in a company once your entire staff has been on that program for years. Finally, if we look at efficiency scale, this moat applies in a market limited in size. Potential new competitors have little incentive or to enter because doing so would lower the industry's returns below the cost of capital. Moats built on efficiency scale apply to a small number of businesses like a large, say, freight operator. They also apply to companies that enjoy kind of monopolies like a public utility, an electricity service company. Now, there are also soft moats. Some of the reasons a company might have an economic moat are difficult to identify. These would be in the soft category. Moats are created by exceptional management or a unique corporate culture. While difficult to describe, a unique leadership and corporate environment may partially contribute to a corporation's prolonged economic moat. Just commentating generally here, in terms of small caps, we find true economic moats at the, say, micro cap level. It's more difficult to define with certainty as the businesses are by definition starting very small. Other than potentially holding intangible assets such as a patent, it can be far more difficult to define a true moat at a small level. A moat initially at this level is often based on opinion. If you're trying to invest on based on a moat as a criteria more than data. Moats are therefore as singular thesis for investing in small caps, often fraught with peril. Yes, Microsoft, for example, has a definable moat, but it's the largest company in the world. Today, Boyd, due to its size, can be said to have somewhat of an economic moat that allows it to have greater purchasing power and reduce costs with over 950 plus locations. But one could not say that when we originally recommended it, and it had around 37 locations. It could only be at that point a prediction or a guess with a high degree of risk. What I'm saying is Boyd did not have an easily definable moat, if any, when we originally recommended it. So a moat is great to have, but harder to define with any degree of certainty in most cases with smaller companies.
Yeah, I mean, I think it's good. I'm glad that you covered it because it's a question that we get all the time. We'll come out with a new recommendation. Well, what is this small caps moat or whatever? And again, sometimes you don't have a moat. Sometimes you can, even just be a small fish in a big pond. I mean, maybe it's not a perfect example, but like even like the music industry, for example, you can have a really, really good music career and not have specific moat or differentiation between all the other country artists or rappers or whatever. Again, to be a successful business, you don't necessarily have to have a definable moat like Ryan was saying. And again, Boyd is a great example of that.
Yeah.
And just on like the size component when we're talking about moat, and people always like to, the one which I always heard in university, because numerous courses would of course talk about moat, is Apple time and time again, because they have their own ecosystem effectively creating that isolated. So if you think about like a actual castle moat, they would have like a nice big wide moat. It'd be difficult to get over for invaders to get over. But then if you think about a small cap, they'd have a small little castle and likely a small little moat. Might be a little trickle of a stream around it, which anyone can just walk over. You can get in the castle easily. And it wouldn't make sense for a small castle, to have a big moat. It just doesn't really make sense. Even in an analogy, it
Yes.
wouldn't make sense. It's adding more like uh, investment into something they don't really need. They don't need that technology. And then if you further look at many of the small caps that we will look at, it's a fragmented business. Why is it fragmented? Because you need to be in a certain geography. And if other people try to come and compete, a bigger company tries to compete, it just doesn't work within that geographic region over and over again. So they may not have a direct technology mode. It plays in a bit into like the efficient scale,
Yeah.
but at that point it really just plays into the small cap favor, and it's not really a distinct mode. You could maybe call it a soft mode, something like that, but it's not a defined mode like what people think of with technology. It always comes back to the technology mode almost when
Yeah.
people are bringing it up, and you
So
don't really need that technology
yeah,
mode.
you could have that moat on a smaller scale in the efficiency area if they geographically were. And we, there's a company, Dynacore, that may be considered in the region that it is to have that type of moat. There's other reasons you might say that it doesn't have a moat too. So, and you can argue both sides of that point. Is it a key determinant in a smaller company? It would be great to have. Like, it would be great to be able to say nobody can beat this company's technology. They have a patent on that technology going forward. It is very difficult to find at that scale. They could gain it over time. Often, a great management team can be an advantage. Do I define that as an absolute moat? It would be soft at best, right? I mean, and then obviously, it has to be a team, because if it's one person, it's a fragile moat if that person is not there with the company as well. So
One
there's,
thing I'll just say about Elon Musk's comment there, it's almost like with what he's saying, he's kind of making the assumption that a moat is just something
yeah,
that just sits there and it gives you absolute protection, or is supposed to, and you don't ever have to do anything to defend it. But if you use the analogy of a moat around a castle, you'd think like, well, no, if your castle is being attacked, the enemy is they're finding ways to like build bridges over the moat or get over the moat, and you're needing to constantly be defending it, and pushing off their attacks, right? So it's, all I see as a moat is just, it's something there that's real, structural, maybe, that is protecting your market share. But it doesn't mean that like you don't have to continue to work on your moat, repair it, defend it, or that it gives you absolute protection, or is supposed to give you absolute protection, because moats obviously can be crossed.
yeah. I mean, I think it's silly to think that Buffett was just saying you built that moat and then you're protected for it. I mean, you'd have to have innovation
Mm-hmm.
going forward to protect that moat. I mean, and it reminds me, I think one of the it's a horrible example of what went on in the real world, but the French after World War One built the Maginot Line. Like, it was a line of concentrated fortifications, obstacles, weapons built, and they spent, at the time, a massive amount of money doing that after World War One, and then the Germans flew over it. So that kind of ended that moat that they were trying to
Well,
build
they actually
around.
went around it as well. They
Yeah,
actually
did
just
they
went
not
through
fly over
Belgium
it
and
at
just
some
went
point
like
too?
right
Yeah.
around it, because
Well,
it
you could
covered
just do.
the border between France and
Yeah,
Germany, but not Belgium. So you could just basically go to the end of the line and
but
walk around it.
going around is just ridiculous too. But there's technological innovation flying
Yeah.
over it as well too. So yeah.
Yeah.
But you've got to continue to innovate. And again, Elon is just kind of taking. I don't think anybody is thinking that Warren Buffett would say you just built that moat and then you're good. This company now you've got to continue to, build on that moat over time.
And just because we're a big history podcast, I just looked on Wikipedia, so take it for what that is. But they spent around 3.9 billion in today's U.S. dollars worth on the Maginot Line. So
Yeah.
3.9 billion. Anyways, thought I'd get that number.
Quite the spend. And then just
They
they walked
drove around
around
it.
and flew over. Basically, that's what I understand.